Well, hello and welcome back to Jones Financial Talk. Listeners, this is Nick Jones from Jones & Associates Premier Financial Solutions. If you'd like more information about what you hear on this show today, you can get a hold of us in a couple of different ways. You can just pick up the phone if you're here in the Rogue Valley and give us a call at 541-500-4321. Or you can go to our website at jonesfinancialtalk.com. Lots of great resources on there, including our radio page. Lots of people like to listen to our past shows. Maybe there's something that intrigued them, a topic that they want to learn more about, and so they can do that. And you can do that as well. Our program is available on Apple Podcasts, Spotify, and even Amazon Music. So please take us up on that offer. Lots of good resources there, I believe. And if you want to, feel free to ask us about specific topics that you want us to cover on the show. That's happening right now as a result of somebody that wrote some comments on our website. We decided to do a full show in a couple of different parts, most likely on rollovers, and specifically 401k rollovers, because everybody leaves their job eventually, and there's so many little technicalities that you need to know about, so many different options you might have. And this has become more and more complicated over the years. Many of you may or may not know that the Department of Labor has changed many of the rollover requirements. And what that means is there are lots of different things that you should be discussing with your financial advisor to see if this type of rollover actually makes sense for you. So what we're going to do today is I'm going to bring in my co-host, Mr. Tony Shore, and he is going to help us explore this topic in a lot more detail.
Yeah, I'm looking forward to it. I pretty much everyone I know has some type of employer-sponsored plan, a 401k, a 403b, 457. And what do you do with it? If you leave your job for one reason or another, whether it's to retire or go to a different job, it's good to know what to do. And there are so many rules and ins and outs and strategies. And there are a lot of, like you said, options. So I'm anxious to dig into it. But first, I have to ask you, how are you? Are you okay with the end of summer? Are you okay with where we're at, Nick?
I am a little sick of the heat. I like colder weather. I love the fall season, and we're going into that right now. And so I'm very, very happy with the weather situation. I'll tell you that.
Yes, cooling off. I love it when it's cooler and crisper at night. You leave the windows open. Don't have to run the AC. I sleep so much better when that happens.
Totally agree.
Unfortunately, in Minnesota, where I'm from, that period of time where that's nice and crisp at night and you can leave your windows open, that's about a 2-week period. So there's maybe 4 if we're lucky.
Heat to snow is what you're saying, huh?
Yeah. Fall and spring are way too short, but I'll tell you what, there's no better place to be in fall and spring than Minnesota. Oregon's beautiful too during those times of year, but
yeah,
we
have a little longer season than you, so we're lucky.
Yes, our seasons our fall and springs are short, but boy, those are nice. Those are perfect weather days. So, but yeah, we've got a great topic today, and this is something that I wish I wish the show had been recorded before I switched jobs about 12 years ago when I switched jobs, because or actually longer ago than that. The job before that I left, I actually forgot about a 401k at a previous employer because it got bought out and we moved over to the new place, and they didn't automatically transfer the 401ks from the old place, even though they bought us out, and I kept doing the same job. So I forgot about that one. And luckily, I eventually found it and figured it out, but that's not good. You don't want to leave that. So we're going to talk about that some. But where do you want to start with this topic, Nick? I mean, people have options with a 401k. Do you roll it over into the new 401k? Do you roll it over into an IRA? Do you leave it at the old employer? Do you cash it out? There are a lot of options, a lot of pros and cons to each of those, aren't there?
There sure are. And maybe we'll start with just some general background information that maybe everybody wants to hear a little bit about, bring everybody up to speed. But yeah, Tony, so, a 401k rollover is basically just taking money out of the account that it's currently in, right? Usually with your existing employer, and moving that money to another tax advantaged retirement account. And as you mentioned, There are many different ways that you can do this for many different reasons. And so typically, when you take money out of one of those accounts, you've got 60 days from when you receive the money from those assets from that 401k to put it into a different type of retirement account. And you need to know where that's going to go, because it's not as easy as just walking into a bank or walking into a financial advisor's office and saying, I've got this check, I want to just deposit it in an account. It takes some time to open up that account. They've got to do a background on your situation, make sure that they clear you through the Patriot Act and all the different things that are required to open financial accounts. And so that's one of the first things I wanted to discuss. You got to have that organized first. So before you even consider doing this, you need to reach out and talk to somebody first, and probably open up the type of account that you're going to move that money into so that it's ready, right? Because a 60-day window might seem like a lot of time, but it can go very, very quickly.
Yeah, and boy, if you don't during that 60 days, you're going to get hit pretty hard. You have to do that. And that's why there's differences between a direct a direct transfer or rollover or an indirect. And I wouldn't want to try to figure all that out on my own. You have to work with a financial services professional who you trust. Somebody like yourself, Nick, I know this is something you've helped so many people with here in our community and your clients. And if our listeners have questions about anything we talk about today, they should get a hold of you. But even more important, don't do any of this without working with a financial professional and looking at your overall situation, right?
Yeah. And, taxation and penalties are a big reason to want to do this correctly.
Yes.
And unfortunately, those are just not current situations that change your financial picture. They can have long lasting effects, not just because of the taxation that's involved and the penalties that are involved, but that increase in income, if you do it incorrectly, can mess up other things, right? It can mess up Social Security earnings. It can mess up Medicare payments. All kinds of different things can be affected if you don't organize this correctly. And so maybe I'll just start, Tony, and explain that with a rollover, there's probably basically about 4 different options of what you can do.
Mm-hmm.
At its most simplest form, you can roll or move money from that plan into an IRA, an individual retirement account. Okay. You could take the money and put it into another 401k that you have if it's available. You could just leave it right where it is, or you could cash it out. And all of those have different implications and different advantages. And so maybe we'll just go into each of those a little bit more, because each has a unique set of not only tax and financial ramifications, but also help.
Sure. So the first one, and I think one of the main ones people will consider, so choice one that you mentioned there is rolling a 401k over into an IRA. When somebody comes to you with a 401k and you look at their situation, what are some things they need to know if they're going to do that?
Yep. So that is the main option that most people take to keep their money in the same form that it is tax wise. So you've got $100,000 that you've saved in a 401k, and you've left your employer. Okay. Or you're at the age where you have the ability to move it out, which we should talk about. The age when you typically have the ability to move your 401k out, if you're still employed by that employer, is right around the age of 59 and a half. Okay. Some plans allow it sooner, even at the age of 55, which we'll talk about later in the show. But the point here is most people, this is the number one thing they do, roll money from their 401k into an individual retirement account. And it gives them the ability then to work with a financial advisor or work by themselves in a self-directed IRA account to buy different things inside that account. Okay. And that's probably the most well-known common way to do it. There's 2 main different ways that you can do these 401k rollovers, either directly or indirectly, which I think you mentioned a little earlier. So maybe I'll touch on that and tell you the advantages real quick. If you do a direct rollover, what that means is you actually never touch the money. Okay. So you open an account, a new IRA account somewhere, say at Charles Schwab, for instance, where we facilitate our clients' accounts, and that account's already open. and you call your 401k. I do this with all of my prospects. I call with them. I don't make them do it on their own. And you talk to your 401k provider and you say, I already have an account open. I already know where I want it to go. And if they give you that option, they will just send those funds directly to that account. That's called a direct transfer.
Yeah.
That's the simplest.
That's simple, and it's good because it maintains the same tax status. You don't get hit with any tax penalties. There's none withheld.
That's right. That's right. And then the second way to do it is what's called an indirect rollover. And that's where you might still have that account open that you're going to move the money into. And I hope that you would, listeners, but you don't have the ability for that 401k company to send it directly to that company, that new company. So what they do typically is they send you a check. They send you a check in the mail, usually regular mail, 7-10 business days. And it's your responsibility to take that check and to put it into that new account that's been opened. So you can see how the 60-day window that you have to complete this can become concerning, right? If it takes you 7 to 10 days to get the money, maybe you forget about it for a week or two, or maybe the account's not open yet, so it takes a couple of weeks to have that happen. It's an indirect rollover because it technically is in your hands. You have the ability to cash that check.
Yeah.
And if you do, huge implications. And so the first thing that I will mention that I just thought through as I was saying this is, do not cash that check and put it in your bank account. Even if you think that that's how you're going to get it to the next institution, you cannot do that. If you do that, you're putting yourself in a situation where you're probably going to owe some taxes or penalties because now you took possession of those funds.
Yeah, you could lose a big chunk of that money, right?
That's right.
By
now,
doing that, that would be a very expensive mistake.
If you've done that, there are certain ways that you can clean it up, but it's very risky. So typically what you want to do is you want to have in either of these situations, a direct rollover or an indirect rollover, you want to have the account established at the new financial institution, and you want to know how the check needs to be made out for them to accept it. Okay, so let me give you an example. Like I said, we house our clients' accounts at Charles Schwab. And let's say that Tony was going to roll a 401k over to an IRA at our firm.
Okay.
We're going to call that company, the company that Tony works for. We're going to have them issue a check in the name of Charles Schwab, but for the benefit of Tony Shore. Okay. And I'm already going to have an account open. So maybe we even notate and put the account number on the check so it's clean. We know exactly where it's going. And then in that situation, we already know that either if Tony gets the check or if his 401k company sends it directly to Charles Schwab, that we'll have the ability to just put it right to his account. Okay. And if the account is established, we have the ability to put a check in on the same day for a deposit. So it helps because if you've got that all organized up front, you don't have to worry about this 60-day rule because you're going to have plenty of time to be able to do it appropriately, and you're going to have it organized. And the other thing that I'll mention just briefly here, Tony, about indirect and direct rollovers is how often you have the ability to do that. Okay. So throughout the years, I should say, the IRS has changed rulings and changed laws many, many times when it comes to the taxation of retirement accounts. And it's unfortunate, to be honest with you, because it feels in some ways like they're trying to trip people up. And these little technicalities can be huge when you think about the tax penalties, because if you don't do it correctly, they just say, well, you didn't read the rules right. You didn't do it right. You're in trouble. Okay. So long story short, in this specific part of the segment we're talking about, a direct rollover can happen as many times as you want on an annual basis today. An indirect rollover, though, can only happen once in every 12-month period. 12-month period, not each year. So if you don't know that little technicality, okay, and you've indirectly rolled an IRA over, and then you indirectly do it again in a 12-month period, now you've created yourself the possibility of a penalty and a taxable event.
Yikes.
Okay, and so how does the IRS even know about that? Every single time they figure it out. But people ask me this question all the time.
They're monitoring this show, in fact, right now.
It's a very good question, right? A lot of people ask me this. They want to know, they want to be sure that they're not going to get taxed. So what happens is when you move money from one retirement account to another, you're issued either a 1099 or a 5498, which shows where the money came from and where it went. And
Sure.
if they cannot match those up, and if the dates don't work correctly, that's how they know if you've done it incorrectly or not.
Yeah.
So all of those little things, right, that we've just talked about, we've only talked about the first type of rollover, can be taken care of if you have a conversation up front with an advisor about that.
Yeah. Yeah, and I think that's really important. Obviously, I would not want to try to do all that or any of that on my own. I mean, it's just it can get too complicated, and the mistakes. It's easy to do it the wrong way and make a mistake that's going to trigger, like you said, a taxable event and on top of the taxes, a penalty. So you have to work with somebody like yourself. Like you said, set up an IRA first. I mean, most people aren't going to, okay, I have this 401k. I know that everybody says a good thing to do is transfer it to an IRA. Is that right for me? And how do I set up an IRA account before that happens? How do I make sure I'm doing it in the most efficient way and tax efficient way? Well, the only way you're going to really figure that out is if you're working with a trusted financial professional. And Nick, I know you've helped so many people out with this. This is one of the big things you do for your clients and help them roll that money into an IRA. So that's your first choice, is rolling from a traditional 401k into a traditional IRA. What if you have, I know some people have Roth 401ks these days, right?
So the process is very similar, but you have to have a Roth IRA open, which is the same tax status of an account, to be able to accomplish that.
Sure.
Okay. And so if you have the ability to invest in the Roth format inside your 401k, you would open what's called a Roth IRA to roll that money into. You can do it in either of the two ways we talked about, indirectly or directly, for the same benefits that we discussed. Okay. But that's just the way that you would want to keep the tax status correct in those types of accounts.
Right.
And if you decided not to do a rollover into an IRA, Tony, you have other options. So one of those is if you are working still at another company, in many situations, your new company will allow you to take the money and put it into your new 401k. Okay. There are usually limits on how much money has to be held inside that account before they can basically tell you can't have it there any longer. Okay. So if you're leaving an employer, there are some plans that say if you have less than, say, $5,000 in the account, they're going to automatically make you move it out. Okay. But others will just let you leave it there forever. Okay. And a lot of people do that. I have a lot of prospects and clients that come in and say, I had a 401k in these 3 different companies and they're still just sitting there. Okay. Now, the problem with that is you've got stuff all over the place, like you talked about, Tony, right? Earlier, like you were mentioning to me.
There are probably a number of problems with that, right?
There are.
Yeah.
And so if you
I can
consolidate all of
attest to
them,
that.
if you consolidate all of them into that new 401k that you have, there could be additional benefits and things that you'd want to think about other than just consolidation. But you're correct. If you're working with a fiduciary and a financial advisor that is following all the Department of Labor's regulations like they should be, they're going to be documenting this and explaining to you what your options are and why you should do it. Okay.
Yeah.
And so let's talk again maybe about why you would consider the rollover, okay, rather than doing a 401k to 401k transfer.
Right. And, I had that situation come up, and there are a number of reasons you don't want to, and you're going to give them to us. But I remember, and I don't know if it was you or your brother, I remember somebody saying to me once, you're no longer working for that company. Why should your money be there, working for that company? So
That's right.
yeah, that's a biggie. Just the principle of it, I think, is one, right?
Yep. And, typically the way that 401k plans are built is there's not a lot of interaction with the financial advisor and each of the individual participants.
Right.
And so the investment options typically are smaller. What I mean by that is there's less choice and they're more broad to try to take care of everybody's needs. But if you've got a 100 or 200 or 1,000 people that work in the organization, and you've only got 20 or 30 choices to invest in, that's not a very good broad investment base, right?
No.
So
It's more of a one size fits all, which never works with investing in finances, as
that's right.
You've told us before.
And so people that are listening probably have heard of different portfolios that are exactly that. Target date portfolios, for instance, where
Right.
depending on the date you're going to retire, that's the portfolio you're going to be put in. So I'm 60, let's say I'm going to retire when I'm 65. It's a 2030 portfolio. 5 years from now, it's going to be ready for me to retire. Okay. The interesting thing about those types of investments is they're just not tailored to everybody's individual needs. They are, and in some cases, in many cases, cheaper for sure than working with a financial advisor. But can the financial advisor that you're working with provide you with better value, even if it costs you more to work with them? And more importantly, can they provide more investment opportunities, better, broader investment options for you that you would actually want to take advantage of? Now, if they have a platform like ours that is organized that way, then the answer is yes, they absolutely can. And that's a huge reason why many people come and work with our firm, because they don't have the ability to have the exact investments that they want to use inside the current 401k plan that they have.
Well, sure. I mean, and the only reason there are many reasons why you pay a little higher fees if you're working with a independent financial advisor like yourself versus just having your money in the company 401k. The company 401k isn't going to help you set up that IRA account. They're not going to help you look at your tax situation, look at where you're at personally with your finances, look which option is better for you personally based on your goals. They're not going to sit down with you. What are your goals and your needs for this money?
Yep.
And are they going to help you maximize your Social Security or with your Medicare or
Yep.
Other types of investments? No, they don't do any of that. They don't give you any advice. It's just a place to put your money. In fact, now this is a number of years ago, but one of my first 401ks that I contributed to, it was a fairly large company, but literally you checked a box: high risk, medium risk, low risk for your 401k.
Three questions.
There were 3 check boxes, and I don't even know if that's legal anymore, because now it seems there are, like with my current 401k, there were more options than that, thank God. But it's pretty much that's it. Are you high risk, medium risk, or low risk? And then they have very narrow funds, and that's for everybody, right?
Yep.
And so, yeah, I like the customization ability to work with a financial professional.
Well, and I want to step back here for a second and just explain. If the 401k that you have is designed correctly, then you can avoid a lot of those things. But the problem is most employers don't take the time to work with a financial advisor directly to do that.
Nope.
We do manage many 401ks here locally, but we have done our due diligence. We've gone and we've talked to the business owners. We're offering many different investment options to their staff rather than just that kind of cookie cutter thing.
Yep.
We're sitting down with their staff. We're talking to them about their investment choices. We're asking them what they're trying to accomplish. We're not just saying buy one fund.
That's
right.
good.
And so they can be done well. And the other thing, Tony, also is there are lots of reasons not to move the money from the 401k to an IRA. Okay.
Oh, sure. Yeah, there are a lot of advantages. But now getting back to, you started talking about some of the disadvantages to leaving money in your old 401k and not moving it with you when, or not rolling it over into an IRA or putting it in your new company 401k and just leaving it. And I'm a perfect, my story is a great example. One of the big ones is you might forget about it.
Yes. Yeah. And if you forget about it, then it's definitely not being looked at and managed on a regular basis. Right.
Yeah, that happened to me. I mean, it was a unique circumstance because my company got bought out and we merged with this huge company and we all went over there. I did the same job I did in the bigger company, just a different cube, and we all moved over there.
Yep.
But a couple of us they didn't talk to us about the 401k. And if they sent out an email, I must have missed it. And so years later, after I was leaving that job for this one, and I looked at my 401k, I'm like, wow, that should be a lot bigger. right?
Yep.
Because I'd
And you're
spent
like, where was it?
I worked there 10 years, and so the first 5 years was missing, right?
Yep. Yep.
So I scrambled through, luckily, boxes of saved papers and receipts from previous years. Luckily, we had saved, and I found a statement, and we had moved, a couple of times. So I wasn't probably getting the mail, forwarding address maybe it had expired, but I found one and said, this was it. And we contacted them and got it handled. So that
Yep.
was good.
Yep. And you bring up a good point, reasons to not do a rollover also, right? Reasons to keep it there in that 401k plan, all things being equal. And a lot of the benefits I'm going to talk about here, Tony, are for people that are still working at that company. Okay.
Sure.
But if you think about the reasons why maybe you would want to keep your money in that 401k, and I hope that if you sit down with an advisor, they play a devil's advocate here and tell you both reasons, either moving it to an IRA or not, are a bunch of things. First, you could have limited creditor protection if you leave it inside the plan. Most 401k plans are protected by the Pension Benefit Guarantee Act. So that can be helpful if there's an issue down the road in some situations. Also, you do have other logistical nuances to every 401k plan. You have the ability in some situations to take a loan out. For instance, if you want to borrow some money to do something, say you want to buy, I don't know, a car or a boat or put a down payment on a house. Many plans let you take, say, $50,000 or 50% of the account value out. And how do you pay it back? You pay it back in the form of a loan, where you're paying yourself the interest to be able to have access to do that. So loans are a nice thing that are an option in 401ks. There's also lots of different distribution factors when you're thinking about 401ks that are different than IRAs. And your advisor should be looking through that for you.
And these you're talking about advantages of having money, leaving money in your 401k at the company you're currently working at.
That's exactly right.
Yeah. These are not advantages to leaving it in your last company.
No, because
just to clarify.
a lot of the things that I'm mentioning here are only really good if you're a current employee and have the ability to do this.
Right.
Okay. If you've left the company, they're not going to let you have a loan on that investment. They're not going to let you have different savings of fees and things like that if you're not an employee. But if you are still an employee, you really need to consider what the benefits of keeping the money in that place are.
Sure.
You could have access possibly to be able to take that money out sooner. And so there are lots of different rules that allow in 401ks you to take the money out as soon as the age of 55. Instead of moving it into an IRA.
Yeah.
Okay. So you need to talk through really what your goals are for the money with the advisor that you're working with. You need to understand that there are definitely advantages to doing both, either leaving the money in your current plan or moving it to an IRA. And they should be helping facilitate that conversation so that you have the ability to make an informed decision.
There you go. Well, we're going to stop right there, and we're going to continue this discussion on next week's show because we have so much that we didn't get to, and this is such a huge topic, and there's a lot to go over, and we're going to get into some other details about 401ks and retirement accounts in our next episode. But before we go today, let our listeners out there know how to get a hold of you, Nick.
Sure thing. If you want some resources about anything you heard on the show today or just have any general financial questions, go to jonesfinancialtalk.com or pick up the phone here in the Rogue Valley and give us a call at 541-500-4321.
All right. Well, Nick, great show today. Listeners, that does it for today's episode of Jones Financial Talk with our host, Nick Jones.